Well, hello everyone. Colin Harper, Brian Peluso next to me, and Michael Kutch. Welcome to Friday Live, the part of the show where we talk a little bit about the markets, give you some interesting planning topics. Brian and I haven't been together forever because he's been all over the country watching hockey. So good to have you back in the office again.
Back on Friday Live.
The hotel Wi-Fi is very spotty. We've tried it a few times with very little success. So just a quick reminder, nothing we talk about today should be taken as specific advice for your situation. These are just our thoughts and opinions on, general topics in the markets as a whole. Mike, why don't we start with the banking landscape out there? I know you and I did kind of a special take on Monday where we just talked about what's going on with Silicon Valley Bank and some of the concerns there. And to sum up that conversation, at that point in time, we didn't think it was a broader issue, right? We thought we really need to decide if the market's going to have an emotional response to this, or if there is actually underlying economic concern, depending on whether we saw emotional fear versus that underlying economic concern, I think would give us a bit of a clear indication moving forward from here. What have you seen since we chatted on Monday and how that's played out?
And we should mention this is St. Patrick's Day, March 17th,
oh, thank
2023.
You.
So we're about 1 week out.
Where's your green suit, Brian?
What's that? I do have green stripes on it. I got green stripes.
I have. This is as close as I could get to green when I forgot it was St. Patrick's Day this morning and made my way in here.
I am Irish. Even though my last name is Italian, it ends in a vowel. My grandmother on my dad's side was all Irish.
That's where all that love comes from.
Yeah.
Not this week, but
not this week. Yeah. So we're about 1 week out from the Silicon Valley Bank situation, and then there was a few others. So Mike. So to go ahead and address Colin's question and kind of what we're thinking and what we're seeing right now.
Yeah, it's really amazing how 10 days can really change the story. Last Wednesday, I think, Tuesday, Wednesday, Powell testified before Congress and was talking about pretty much how well the economy is doing. Inflation's coming down, but ultimately they're probably going to have to go higher for longer. It was really being priced in that we're going to get a half a point increase at this meeting and probably get to a peak rate of 5.75. Well, that story's really changed. And that started out with the two banks last week, Silicon Valley Bank and Signature Bank. And the FDIC came in over the weekend and pretty much insured those depositors even above the 250,000 threshold, as well as opened up a lending facility where all these banks can get up to 1 year loans using their pretty much their assets they invested at par value instead of the market value, which is down. So what happened with Silicon Valley Bank specifically was they took in a ton of deposits 2020, 2021, and they did a really poor job of managing those assets. They classified most of them as held to maturity, meaning they don't really have to disclose those unrealized losses until they need to sell something out of that portfolio, which is something you really don't want to do at a bank. So they had a lot of losses, and then pretty much in the modern age, once a tweet goes out, everyone pulls their money. So they had like 40 billion of outflows on Thursday alone. So they didn't have the liquidity to cover that. They tried to do a capital raise and failed. So they're pretty much bad news from there. So
when that capital raise was the blood in the water for the rest of the sharks that hadn't already taken their money out. So that didn't work out at all for them.
And they also had a very concentrated customer base where it's a lot of the startup companies. So it hasn't been a great environment for startups over the past year and a half. So once those companies started taking money out, it's really started the problem. And Signature Bank had a little bit of a different story, but also that concentrated customer base. They're big in the crypto space. So you can talk whether it's bad that the Fed came in and people are saying bailed out. It's not really a bailout. The company's kind of done. They're pretty much just protecting the depositors and trying to prevent other regionals from facing the same issue, which could be a concern. I mean, even if you don't have that concentrated customer base and have most of your assets in the under 250,000 limit that's covered by FDIC, it's all about confidence. And that's really what this situation is about. It's not like '08 where it was toxic assets on the books. It's a lack of confidence in the banks.
And I think that emotional response is what the FDIC is the most worried about. Because realistically, and most of the folks we work with, don't hold bank balances at one institution above 250,000, because we've advised most of them not to, because there's no coverage there should an event like this happen. Although these events are fairly rare, and obviously there were some underlying causes of this that Mike just kind of went through. There is, I think, fear. If you look at the CNN Business, they always have the fear and greed indicator, and fear and greed are, extremely driving forces behind a lot of decisions that consumers make. The institutions, not so much. They've kind of done they do a pretty good job of taking emotions out of most of their decisions. But from an individual, and especially those regional banks that aren't quite as big and aren't quite as diversified, it was interesting to see the FDIC step in and put such a hard stance to try to make this an isolated incident. Mike, you mentioned we may still have some trouble going along. I know. I think ever since 2008, there's a general distrust of banks, no matter who you ask. I mean, there's a general distrust of banks, and I don't think there's any way that we're going to overcome this. It certainly isn't helping. And so the first bad sign, I think people are apt to run to the hills. And I think a lot of people were burned so bad in 2008, they don't want to see that again. But Mike, to your point, the FDIC was as clear as they could be that we're not helping the banks, we're helping the depositors. So I thought that was a good message. I was surprised they did it.
Because in 2008, they really helped the banks.
Absolutely.
Because they saved the banks.
They saved the banks. And, that left a bad taste in a lot of people's mouths during it. I think it was necessary to keep everything going. However, left a bad taste in a lot of people's mouths. So this was very much, let's help the depositors, not the banks. And that's, Mike, to your point, what there. So kind of now that you've wrapped it up a little bit, what'd the market say about all this week?
What can you give me a specific day? It was up, it was down, it was up.
Maybe a specific hour.
Yeah, exactly.
I think let's see. So Monday, there was some news about Credit Suisse. They've had problems for years, but they had big outflows in the fall, and I guess they went to the Saudi National Bank and wanted to see if they would put in any additional funding for them. And they said no. They kind of said it was mainly because of regulatory reasons. They can't have that much stake in a company. But then ultimately, like Tuesday or something, the Swiss National Bank came in and kind of said they would provide them liquidity. But then we also had the First Republic getting downgraded because of their concentrated customer base. They saw a lot of outflows. So actually what happened, I think it was as soon as last night. It's been such a long week. It's all kind of blending together.
Yeah.
They got $30 billion in liquidity from all the other banks putting $1 billion to $5 billion in their deposits just to cover their liquidity. And I think they'll keep those there for 120 days. So that should help, but it's not helping the stock today. So we'll have to see ultimately what happens with them and Credit Suisse. I don't think they're out of the woods yet. And I have some fears that, people have been moving deposits from these smaller regionals into the major players just because what if, you don't really know. If you're a small business with 200 million, why are they really risking it at this point? Until the FDIC makes that a law where they'll cover all deposits, I think we could still have these little runs here and there. I don't think this situation's over yet, but the stock market is actually holding up pretty well. It had a really nice rally yesterday. It's really been driven by the mega cap stocks. They're back in favor. They're playing the defensive field again. Cyclicals have really sold off. Financials, obviously. Energy's also down quite a bit. The rate market came down substantially on all this bank news, but kind of stabilized. The 2 years back up to 4, and the 10 years at about 3, 4, 5 today. So I think we get more excitement. Next week we get a Powell meeting. I think it's going to be tough for him because he's starting to obviously see cracks in the economy, but inflation is still way too high. it did come down. PPI was pretty promising this week. That came in lower than expectations. Headline CPI came in a little lower than expectations. Core actually ticked up higher, but most of that was that rent component. I think it made up about 70% of that increase. So I think overall the inflation themes continuing to come down. And if anything, this banking crisis is really going to exacerbate that, just because the lending environment is going to become really, really stringent. And it's really going to cause economic growth to slow. I mean, if they're not lending to small businesses who rely on that, I think we're in for a slower environment. So I think what he should do is probably nothing, but then you have such a overreaction in the stock and bond market.
Yeah.
I think he'll probably go 0.25% and just kind of in his tone indicate that they'll have the flexibility going forward. They want to see how this transpires. I think a no basis point increase, if they don't do anything, it could ultimately spook the markets too.
All right.
If they're not going, even though inflation's so high, the market might say, hey, are you concerned about this? Should we be concerned about this? And ultimately, I think a 50 would be bad for markets and kind of irresponsible at this point.
I did find it interesting that the European Central Bank, Christine Lagarde, came out and they actually did 0.5%.
Yeah, so that could make the case for doing 50.
So, it seems to me to do nothing would be an indication of, oh my, the Fed, Jerome Powell is super worried. To do nothing, to do 25 basis points would keep him on his path of lowering inflation. 50 might be strong. 0.5% increase in rate might be a little strong.
What did we talk about before we talked about rate increases every week?
I don't know.
Like, what was it seems
Couldn't
like,
be that interesting.
God, I mean, it feels like we've been beating this dead horse forever now. And
There's always something.
There's always something to talk about.
2017 tax cuts, 2018 trade wars, 2019 was pretty good, but we're starting to see some economic slowdown. And then 2020, obviously, COVID and rate cuts.
Mm-hmm. Yeah, it's been a couple of years of some really interesting topics. That's for sure. That is for sure.
And I would say we're not nearly out of the woods with interesting topics yet. Mike, anything you're looking forward to? We talked about the Powell meeting next week. Anything else you've kind of got your eye on that has got your interest piqued?
No, that'll be the big one next week. We'll just have to see if any of these other banks come out, or if we see more downgrades like what happened with First Republic. That could really spook investors.
I did see on the news this morning, they interviewed Morgan Fairchild,
Really?
the actress, in front of a First Republic bank. And she said she was keeping her money there. I don't know if that's what people depositors should do, but it was an interesting endorsement.
That's a very interesting endorsement. They set that up. That was a called in favor right there.
You must know somebody on the board of First Republic Bankers. Morgan, get out there. Tell everybody to leave her money. Anyway. All right, cool.
Do you have something else, Mike? I'm sorry. I thought I heard you chime in.
Well, I was just going to touch on the technicals if you want me to go into that just briefly.
I think we could probably skip the technicals for today, unless there's anything that's really sticking out to you want to hit on.
No, we did cross above the 200-day yesterday. Above that, today we're kind of flirting with that level right now. We're still below that uptrend line from October. So being below that's not great, but really watch for the December lows, whether we hold above those. If we don't, I mean, October lows will probably be a realistic target after that.
Very
so
good.
far, markets remaining resilient.
Yeah, it has been impressive, all the resiliency this week, with some ups and downs, of course. Well, speaking of interesting news cycles and talking about concerning things year after year, it's not going away ever, and people are living longer than ever now.
Yes,
if you saw our Facebook post earlier in the week, The planning topic is longevity and longevity risk and some important considerations about some things you can do and should be planning for when it comes to longevity. Mike, fun fact, do you know, I already told Brian, so hey, I can't ask him. Do you know, give it a guess, how old is the oldest person on record?
I can't answer that either. I also heard that.
All right. Well, and if you're watching and you don't know, it is Jeanne Calment, the French woman, lived to 122. The argument is that genetics play a pretty significant role. In my experience, that has certainly been the case, family history. Now, Jeanne stopped smoking at the age of 117 because she got a little bit worried about her health.
Why stop at that?
Yeah,
point?
I don't know. I don't know. So Jeanne lived to 122 years old, the French woman. A lot of it was attributed to she came from a very upper class family, didn't have to ever work a day in her life, and was, exposed to much healthier food, exercise, all sorts of different activities that they attribute to her extreme longevity. And also genetics. Let's just go genetics. I don't think you live that long without genetics. So
I think we're arguing for the wine and cheese.
Wine and cheese.
That's the wine and cheese diet. Right?
And speaking of wine and cheese, it might be a little bit late. I don't think we can get you wine shipments, but if you are interested, we're hosting a webinar, Uncorked with the Markets, where we do a little wine tasting for some of our clients and people are interested working with us. And one of the portfolio managers we work with, City National Rockdale. We're happy to send you the webinar invite. I can't make any promises on getting wine out. If you didn't see that or haven't had a chance to register, please let us know. We're happy to.
But what we could do is we could send out anybody that's interested. We could send out the variety of wines that we'll be tasting. And so it will still be applicable.
So absolutely. Would love to have you join us if you missed the initial invite there. So that was just my side tangent. So why are we talking about longevity? Well, one of the big things is that Ireland has the highest longevity in the EU.
Really?
Yeah. So it must be all the whiskey because I don't know what else it would be. I don't think it's the weather.
It's Guinness and whiskey.
Guinness and whiskey is the secret to longevity.
Who knew?
So what are some important considerations when planning for longevity? I would say one of the biggest considerations is getting an accurate picture of healthcare costs, especially as it relates to long-term care. I'd say that's one of the biggest reasons to plan for longevity. If we kind of start, why don't we start? Brian, we'll start like low-hanging fruit,
right,
and kind of move from there. What are some of the easy things you think people should check off kind of early in that anticipation of longevity?
Yeah, absolutely. And we talk to folks about this all the time. What determines success in retirement? Most people will go right to the market. If the market helps me out, then I'm going to have a great retirement. We disagree with that. The three big things to plan for are longevity, as we're talking about, major healthcare events, and taxes. Those are really the things that derail many people in their retirement. The market's going to do what it does. It goes up and it goes down. Some years are good, some years are not great. Over longer periods of time, generally the market, the S&P 500, let's call it, has done pretty well the longer you give yourself. So the market's going to do what it does. Planning for longevity, to Colin's point, have a good understanding of kind of your family history, of your own personal history, and you can make some estimations on that. Now, in our financial planning, we usually plan out to the age of 90 or 95. We really think that makes sense, just in case. A vast majority of the people that we work with say, oh, heck, I'm never going to live that long. But we've got to plan for that. So one would be just kind of recognize your own personal situation, your family history as well. Make sure your medical is covered. Medicare is available to you at the age of 65. It is actually generally a pretty good health plan. But if you want to retire earlier than that, you've got a plan to make sure that you're covering yourself between when you are leaving the workforce and don't have healthcare coverage through work, and when you get to 65. So you really want to plan for that. You don't want to have a gap there because without adequate health coverage, that would really affect your longevity. So one, recognize your situation. Two, make sure that you've got good health coverage, whether that be through work, whether that be through Medicare, and make sure that you always have that in place. And then start doing the projections. We at HBK Provident Advisors, we do financial planning. We run the projections at all sorts of market scenarios, good market scenarios, average market scenarios, and way below average market scenarios.
Mostly bad these days, because that's all anybody cares about is what does it look like right now if things get worse.
So make sure, we want to make sure where we come into play is that you have the resources available to live the life that you want to, that you have a few extra nickels. If there is a healthcare event, whether that be long-term care, whether that be an individual health event. So one, recognize your situation. Two, be mindful of what is going to really affect you in your retirement. Because I can tell you, and I think we can all say, the older folks that we work with, they pay attention to the market less and less. They're paying attention to what they're doing every day, what their social activities are, and that kind of thing. So even though you could be in your 40s or 50s or 60s right now and say, oh my gosh, the market is just terrible. From our experience, we can tell you when you get into your 80s and 90s, you're probably not going to be paying attention to it. So you want to make sure you have the resources to live out into the age 90, 95. There's a couple of folks we work with over 100, and start doing all of those projections. And as part of that, we can incorporate, remind you to make sure you get your health coverage and explain that. We don't provide health insurance here, but we can also begin to look at the tax impact, which is often surprising to a lot of people. That will affect the longevity of your portfolio. And it might affect your own longevity because a lot of people have tax anxiety.
That's true.
Yeah.
That's very true.
Yeah.
And I think that's really important when we talk about, we always, at least I like to say that rock climbing accidents happen on the way down, not up, right? So if you look at Everest, most of the people die on the way down from the summit, not on the way to the summit. Right. When it comes to financial planning, it's very similar. We see a lot more mistakes on the distribution side of it than the accumulation side of it. Especially for the last decade, before we got into the last couple of years, you could throw a dart at a dartboard, pick a growth fund, and make money. I mean, really, there was not any rocket science to it. So that's one thing. We need to be very thoughtful about what buckets of retirement income we're tapping into to make sure, like you said, Brian, that we're increasing the longevity of the portfolio. Another big thing is, and this really needs to happen at the beginning to kind of protect longevity, especially, and make things around. Make the things easier for the loved ones you have around you. Estate planning needs to be done. And what I mean by estate planning, it's not, people often get bogged down. Estate planning is a scary word for a lot of people, often because there's a lot of terms that get thrown around. I like to call it the alphabet soup of estate planning, right? We've got POAs, we've got ILETs, we've got Rev Trust, IREV Trusts, all sorts of different trusts and acronyms and letters and all these things that get thrown around that become overwhelming very quickly. At the end of this day, estate planning actually is very, very simple. It comes down to who do you want to have assets and who do you want to have control of those assets? And at what point do you want them to have control? And if you can answer those questions, we can help guide you through that process. Obviously, we don't do any legal work here in-house, but we can guide you through that process and at least get you started down the right road. But the big things, the no-brainers, not everybody needs a trust. It's certainly not applicable for everybody. The biggest things, make sure your beneficiaries are up to date. And we review this every year with the folks we work with just to make sure nothing changed. Everything is good on the beneficiary. So make sure your beneficiaries are up to date. Make sure you have a current will. And then, power of attorneys, financial, as well as, those medical directives. You want to make sure that you have an advocate that can make decisions for you should you become incapacitated. We've seen the other end of this where that's not in place and it gets very messy very quickly and causes a lot of stress for your family members that would probably rather be spending time helping and caring for you versus scrambling to try to work through difficulties with guardianship or things along those lines. And from personal experience, guardianship can get extremely expensive if you don't have a power of attorney in place and you're not able to make those, financial or medical decisions for yourself. So that would be something really important when it comes to longevity. We never know what life has in store for us. Plan for the worst, hope for the best, and everything in between takes care of itself, really, is kind of the motto we do our planning by. So that's some things. Another important thing is don't try to wind up at zero unless you really want to. And what I mean by that is there needs to be a cushion at the end of your financial plan. So when Brian mentioned we plan to 90, 95 for most of the folks we work with, we don't plan to run out of money at 90 or 95. We plan to, have a very healthy pool left over at 90 or 95 to either fulfill those estate planning goals or the legacy goals, or, if some sort of long-term care is needed, there's a couple ways to go about that. And I think that's a question we get a ton too when it comes to longevity, is long-term care planning and what's our philosophy and how do we address that? I would say there's a couple ways to address it, but if we look at any insurance, I think those themes kind of ring true. You can assign the risk or retain the risk. And what I mean by that is we can pay an insurance company to take over the risk of long-term care, or we can retain that risk and use assets that we've gathered ourselves to retain that risk. There is also some, I'll call it niche planning, and you may disagree. We can have a conversation about this. I'll call it more niche planning, where there is a strategy I've seen employed a couple times, and maybe a handful of times that I've seen it employed, I've agreed with the decision to do it. But there is a strategy to gift away all your assets, and basically have the government take care of your long-term care needs.
Right.
My philosophy is, if you're not in that position where you need that to happen for something, that personally, I don't want the government responsible for any of my decisions that they don't have to be responsible for. That's a personal preference, right? So that's, I would say my opinion on this is a bit biased, but I'd love to hear your thoughts on that specific strategy, because that's a question we get quite frequently. It's like, I heard if I give everything away to my kids, I don't have to worry about the government taking it if I need to go into long-term care or something like that.
Yeah, Medicare does not pay for long-term care. It will pay for some rehabilitation, depending on what the health condition is, but it does not pay for long-term care. Medicaid does. And so there is a thought that if I give away all of my money, all of my possessions, and I qualify for Medicaid, that they'll pay for my long-term care. I see that as generally a very myopic way to look at the world, is that you give everything away so that you can, Medicaid will pay for long-term care. We much prefer to either assign that risk to an insurance company or retain that risk by having a pot of assets available to you later in life, should you need that. And it's very hard to do. There's a look back period. There are certain qualifications on what assets you can still possess, how much you have in the bank, unless you're a Silicon Valley bank.
It doesn't matter.
That's different. Yeah, that'll qualify you for Medicaid real quick. How much you have? Nothing. No, those people will be covered. Anyway, so that's hard to do. And but it does become challenging for folks that have not contemplated that. They do have a long-term care stay for an extended stay, and their family begins to sell down assets, or heaven forbid that long-term care facility comes and says, "Hey, you owe us a bunch of money, and we got to start selling houses and cars and things along those lines." So that's really the issue there. Philosophically, we don't think it makes a whole lot of sense to try to give everything away to qualify for Medicaid. Let's explore all of the other viable options before we get into that.
How about annuities, Brian? Do they count toward that?
They do. They do. So, yes. Yeah, so that would count towards an asset. So
But not if you annuitized it.
no, not if you annuitize it, then the asset is only the income that you have coming in. Yeah, exactly. So it depends on how that annuity is structured and how the payments are structured. If it's purely annuitized, and then it would only be a portion. However, if you're taking out a guaranteed minimum amount and you still have a pot of money in there, then that pot of money would be considered as an asset.
Okay.
Yeah. I would say that, to kind of conclude, if here would be my observation. My observation on not only in working with a lot of clients at different stages of their life, but also a lot of things I have read about longevity, which is something that is interesting to me. I would say the number one factor in longevity is staying active.
Absolutely.
Staying active mentally, staying active physically as much as possible. And maybe the most important, some of the studies have indicated that staying active socially, having a good social network, friends and family that you're staying in touch with on a regular basis. So staying active is really the key, and that is mentally, physically, and socially as much as
And
possible.
I think that's why we saw such an increased mortality rate in older folks during COVID, is because their social circles were, ripped from them.
Yeah.
And a very, very sad thing where a lot of people had a really tough time getting out and socializing like they normally would. So absolutely. I think there's a ton to be said about that. And we always, one of the questions we always ask our folks who are about to retire is we're like, what are you going to do? And I can tell you pretty quickly who I'm going to have a conversation with in a year or two that's going to be loving retirement, and who I'm going to have a conversation with in a year or two that just is kind of grumpy and lost. It's sad to say, but there's a very, a lot of folks we work with, they have passions outside of work. I think the people that we work with that enjoy their retirement the most are very involved in organizations, charities, even grandkids and family. I know people that have a reason to retire and something to do with their time. And a lot of folks we work with are busier now that they're retired than when they were working.
Yeah,
we call them to do a review and they're like, well, I'm booked out 3 weeks. Can we get together in 3 weeks? I've got to babysit this day. I've got to go to this, I've got to go to that, which I think is kind of our unexpert opinion on longevity. Find something you love to do in retirement and try to do it as often as you can, and spend time with people you love. And that is a success from our observation for a fantastic retirement.
And Colin is our in-house hobby specialist. So if you're retired, something to do.
If you need a consult, if you're interested in picking up a new hobby, chances are I've tried it extensively. The only thing I'm really, really bad at is basketball. So if you're trying to play like church league basketball, I'm not your guy to talk to. No chance there. No chance there. But everything else I've given a go. I've given about everything else a go, so happy to consult on hobbies. It's a free service we offer here. My wife accused me. I don't collect anything, right? I'm not a sentimental kind of guy, but my wife accused me a long time ago. She's like, you don't collect anything, but you collect hobbies, and it's a problem. So I've been banned from new hobbies. I've got to start recycling at this point. For now. She said, you have a new hobby. It's called parenting. Get used to it. Well, thank you for joining us on this Friday Live. As always, it's a pleasure to have you. I hope you have a fantastic St. Patrick's Day. Hope you're going to a parade, doing something fun, enjoying your favorite green beer. We will see you all next week's not Good Friday, is it? No. We got to, okay. We will take Good Friday off, but so next Friday we will see you. Hope you all have a safe, happy, healthy weekend, and take care. Look forward to seeing you. If you have any topics you would like to hear about, feel free to leave a comment here and we'll kind of read those afterwards. We're always open to kind of adding new topics. Again, every Friday Live, talk a bit about the markets, talk a bit about planning. Love having you guys join us. Mike, Brian, thank you as always. We'll catch you next week.
Happy St. Patrick's.
All right.